Hey guys, Marcel here with Rob again, and welcome to our second market update. These are updates we hope to do on a monthly basis to keep you guys updated. And so, Rob, how are you doing today?
Doing well. The markets keep giving us lots of things to talk about.
Yeah, I mean, I would say I used the word unconventional in my last article, and I feel it summarizes what's going on because you wouldn't think the markets would keep chugging along or keep celebrating the news in a general sense because it's mixed reopenings and the economies and outbreaks. It's mixed news, and usually markets don't like unknown. But right now, things seem to be pretty steadily improving as far as markets go. So maybe let's start
Yeah,
there.
yeah, and I think I think one of the themes that we've had over our few videos we've done so far has been you really got to look at the specifics when we're talking about the market. It's easy to kind of think about the market as one thing, but really it's the sum of a lot of smaller things. So
Yep.
we've really seen a continuation of what we saw before, which was things like tech doing very well. Software continues to eat the world. And things like financials and energy and real estate continue to do less well as the relative issues that we all are aware of in those sectors continue to persist. However, I mean everything is really continuing to head in the direction of recovery. So now year to date we're actually positive in the U.S. So the S&P 500 is now up about call it 1.5%, one to
Yeah,
one and a half.
just recently, eh?
Yeah, exactly. Just recently. And in Canada, we're not doing quite as well. We're still down, maybe 3.5% year to date. But that's really just because of the mix of, we have a lot more exposure to financials and to energy. So, and
Okay.
those are kind of the two sectors that are in the penalty box, if you will. So, that's probably about a 5% improvement from where we were during our last market update.
Okay.
So, and I mean, yeah, it's really been very similar to what we talked about last time in terms of sector makeup.
Right.
So things like communication continue to do well too, and yeah, so Shopify keeps its
In
upward
Canada.
trajectory in
So
Canada.
it seems like investors are really looking at who's gonna not only benefit but come out stronger on the other side of this. It's like investors are pretty much putting bets on subsections of the market, and those subsections have almost outperformed to the point where the whole market seems to be doing very well. Is that fair to say?
Yeah, I mean, and that's actually a great point because the top three names in the U.S. We talked about index concentration in our active versus passive video, but
Yeah.
the top three names in the S&P 500 being Apple, Amazon, and Microsoft have continued to go up this month. So that, let's say they're probably about 10 to 20%, depending on who you look at for the month, which really brings them, it's these top three names in the index, which represent a large percent of the index at this point, up between 30 and 70%. 70% in the case of Amazon. I think they're up about 68% or something like
Yeah.
that
Yeah.
year to date. So, very strong performance from these top three names. And that's really done a lot of heavy lifting to bring the index to where it is now.
Yeah. It's doing a
Um,
lot of the floating, right?
Exactly. Yeah. So I mean, there's still lots of worthwhile conversations to have in terms
Yeah.
of what's going on under the hood.
Okay. What about bond markets? What have yields been doing recently?
Yeah, I mean, yields. It's really continued. It's like the same trajectory it had. So yields continue to fall slightly, and it's always kind of a little complicated to talk about because when yields come down, it pushes up the price of
Yeah.
bonds. It's
The
a good
prices
thing.
bonds are actually doing good.
Yeah, exactly. So it's always kind of a little odd, but yeah. So they've continued to go up in value. So we've
Yeah.
seen the 10-year interest rate for Government of Canada bonds go to about 0.5%, and the 10-year interest rate on U.S. government bonds at about 0.6% now.
Okay.
So it's a couple basis point fall from where it was before.
What about
When we talked
corporate
about.
debt?
Yeah, and I mean corporate credit spreads continue to be healthy and come in slightly. And I mean it's always I think it's worth trying to explain really what corporate credit spreads are. We talk about risk often, and we talk about the stock market and how some names have done well and some names haven't done well. And really, the names that haven't done well are the ones that really have more risk embedded in it. And in the stock market, it's a little more implicit. It's not as obvious, but you would kind of say like there's more risk with these companies with their earnings, and so they're not going to perform as well. But in the bond market, it's a lot more explicit because you take this Government of Canada rate or this U.S. Government rate, and you treat that as a risk-free rate. And then when you look at a company's bonds or a company's debt, and you look at buying it, you actually look at it as a spread over what the yield on that is going to be over and above that risk-free rate as a risk rate, as basically getting paid for taking on risk.
Exactly.
And so as risk got, as a lot of uncertainty entered the market, those credit spreads became very large because you wanted to get paid for the risk. But now as government stimulus continues to come in and central bank stimulus also, those credit spreads continue to kind of tighten in and go lower. So that ends up pushing, and as we talked about, as if credit spreads come in, it means that the price of those corporate bonds are going up,
right?
Because lower yields mean higher prices. So that's kind of the backdrop for the bonds.
Yeah. So bond market's going up as well. So what would be the economic backdrop kind of laying the land for this type of market performance, if you will?
Yeah, well, in Canada, we actually just had the Minister of Finance going through and talking about the new deficit projections that we have, which are about $350 billion for this year, which is substantial. It's very large. And I think it was larger than most people expected. There were some whispered numbers of 300 billion, and that being quite a large number. And but at the same time, we've seen interest rates come down a lot, so the cost of servicing that debt is also lower. And we basically the projections are that because of the way they've been refinancing their debt, it's very possible that the federal government's going to pay less in interest this year versus last year, despite having this huge balloon.
Yeah, I was going to say the ballooning deficit in public
exactly.
debt.
And we also had the Bank of Canada out last week, where our new governor, Tiff Macklem, introduced a new policy mechanism called forward guidance. So what that really means is trying to give the market more confidence in where interest rates are going to help markets function better and to help with keeping borrowing costs low. So basically saying that interest rates are going to stay low for a long time. That really helps basically market participants, investors in debt, feel more comfortable paying lower interest rates, lower yields, or paying higher prices, if you will, for those assets. So that kind of that creates more stimulus because it decreases the cost of borrowing for companies and for governments, as we've talked about. So that's really the kind of the backdrop there for Canada. And I mean, we've seen economic data. On our last update, we talked about expectations starting to get higher for as reopenings happened, activity would start to increase. But now we actually have some of that data. So retail sales in Canada in May were very, very healthy, very, very strong. We got that today, so up, call it 18%, something like that. And then we've also seen some whisper numbers for June, basically saying that we've recouped a lot of. We're back to that kind of year ago number that you'd like to see.
Okay.
But a lot of that is kind of hard to interpret because there's some pent up demand. So if you look at March and April, there was a huge a dearth of purchases in retail locations and online. So basically, you have people who had put purchases on hold, and now they're kind of flooding stores to really make those purchases. So it's not necessarily an indication that we're back to normal, and we see that in the jobs data where unemployment is still high. And so in the U.S., it's very similar. It's actually they've actually had a little bit of a better recuperation in the U.S., but unemployment is still at 11.1%. And so we're still not seeing those jobs come back.
And speaking of jobs and reopenings of the economy, we still have to keep an eye out on the mixed results certain states and certain areas of the world are having with these recent breakouts. I think that'll be probably the theme to watch, or the cloud hanging over this recovery, if you will, going forward.
Yeah, I mean, the second wave, I think, is going to be the topic of discussion for this coming month. I mean, we just see so many states entering into new highs in terms of cases, and really it's going to be, can we reopen the economy without dealing with another surge in cases?
Yeah.
And it's not just the U.S., other countries as well. Seeing Spain and lots of just specific areas too. And some countries are just having some hotspot breakout areas. And then also we're starting to see the emerging markets are really having a hard time, like South Africa, Brazil. Like there's that's kind of the next phase of the crisis is what happens in emerging markets. So I mean, there's a lot still, a lot of lifting still to do before we're out of this crisis.
For sure.
But yeah, so I think these market updates will continue to be useful as we kind of go and navigate through the waters.
Yeah. All right. Well, thanks again for your time, Rob. We'll do this again soon.
Sounds good.
All right. Cheers.
Cheers.